Hello and welcome to our Forex seminar. In this section, we are going to focus on really understanding the Forex market, the foreign exchange market, understand why and how currencies move. We will look at the likes of majors, exotics, and minors, or if I was to put in the right order, majors, minors, and exotics. Understand, what pairs go within there, the pros and the cons as well attached to it. Understand our reliance on the US dollar and overall, the benefits and the cons associated with investing in this area. Okay, as this will be essential as a lot of investors and a lot of potential clients will be having some form of exposure, whether it be day trading or long-term investments within currencies. So we'll focus on all these components and yeah, any questions, please leave them in the comments. Okay, now we're going to delve deeper into the idea of Forex trading and really understanding how it works. When we talk about Forex, it is just short for foreign exchange. It refers to the global decentralized market where currencies are traded. So it is the largest and the most liquid market in the world with, average daily volumes being in the trillions. Okay, so Forex trading does involve the buying and selling of currencies with the aim of, making a profit from the fluctuations in the exchange rate, ideally intraday movements, or they could be spanned over days, weeks, and months. But when we talk about a decentralized market, this naturally refers to a financial market where trading activity occurs without any form of a central exchange or a specific location, okay, physical location. So instead, transactions happen directly between participants. It can be done over the counter. It can be done through trading platforms or other intermediaries like broker dealers, for example. Okay, so that's in contrast to centralized markets where trades go through a single regulated exchange. So that could be the London Stock Exchange, could be the New York Stock Exchange, could be the Tokyo Stock Exchange, wherever it may be. Okay, so understand the key difference between centralized and decentralized. It's not to suggest that the regulations are different from a decentralized market, but it's just the fact that there is no physical marketplace. Everything is done very much online between participants. Now, when we look at a lot of the players in the Forex market, there are a range of participants that are involved. There are central banks, you've got your commercial banks, you've got hedge funds, corporations, institutional investors, and then retail investors, you and I. Okay, and all of these participants engage in currency trading for their own reasons. It could be for international trade, it could be for investment purposes, it could be for hedging, or it could just purely be for speculation. Okay, just betting on daily movements, intraday movements. So one area that you've got to break down if you're not too familiar is the fact that currencies are traded in pairs. Okay, so each currency pair consists of a base currency and a quote currency. The base currency is the first currency listed in the pair, so the one on the left, and then you've got the quote currency, which is the secondary currency, which is quoted on the right. So in our example here, we have got sterling against dollar. Okay, and we've got one spot 2955. Again, that's just is there and thereabouts, let's put it that way. It's naturally going to change on a daily, weekly, monthly basis. So what that means is for £1 or £1 British, it's the equivalent of one spot $2955. Okay, whenever you go and exchange currency when you're on holiday, again, it's only down to 2 decimal points. It'll be one spot 29. The 55 will never even be in the equation when you see it listed. Okay, so if I'm going to the US, my £1, I can purchase something for one spot $29, for example. Okay, so if I wanted to exchange it, I would receive that much in dollars. So that's just the basics of how a pair works. Now, I will go into more detail in other slides, but if I was to go long and buy this pair, I would believe that sterling will strengthen against dollar. So if I go long of sterling dollar, I believe sterling will strengthen against dollar. Okay, that could be down to multiple reasons. It could be down to strong data out of the UK. It could be down to political stability in the UK. It could be down to a weak dollar as a whole. All right, and I'll come on to other factors later. But if I was to go short of sterling dollar, I believe that sterling is weaker than dollar, or dollar is stronger than sterling, whichever way you want to phrase it. Okay, so if you were to go short of this pair, you would believe that we've maybe had weak data out of the UK. It could be turmoil within the UK. It could be the fact that we've just had stronger data out of the US, okay, which has strengthened it and has a lot of investors flocking towards it. So that's the basics of understanding how a pair actually works. Now we're just going to focus on some of the characteristics of Forex trading. You would have heard the word pips a number of times if you've looked at videos in the past, or it's something that you're currently, trading. Now, when it comes to any form of pair, a pip is percentage in point, really. That's what it stands for. It's the smallest price movement in the exchange rate of the currency pair. So it represents the fourth decimal place, okay, of the currency. So if we look at our example here, 1.2955, the last 5 is a pip, okay. And if we say, for example, sterling is up 10 pips, for example, or sterling dollar is up 10 pips, it means that that pair would go to 1.3005, for example. Okay, it's gone up 10 pips. Actually, no, sorry, I'm reading it wrong. It's 1.2965. It would have gone up to. Just shows how bad my eyesight is. So just always remember, it is counting back from the fourth decimal point. That is what is classed as a pip. Okay, now if we look at the bid and the ask price, there are two prices for each currency pair. It's always got to be the bid and the ask. The bid is the price which traders can sell the base currency, while the ask price is what traders can buy the base currency at. Okay, so the difference between the bid and the ask price is going to be known as the spread. That naturally belongs to the provider who's actually allowing you to trade. That's where they make a lot of their profits, through the spread. The spread can be short or it can be wide. Spreads which are very tight highlight a very liquid market, huge amount of volume going through it. Actively traded, you like to trade something where the spreads are tight. If the spreads are wide, it could be meaning that there's low volume, lack of liquidity, or you're trading in outside of hours where there's virtually no one there. Okay, so always trade when spreads are tighter than wider. Then you will have leverage, which is the key factor for many individuals. Typically all Forex and CFDs, for example, allow leverage. This allows traders to control larger positions with a smaller amount of capital. Okay, so leverage amplifies both your profits as well as your losses. So it's important to really understand and manage risk. You can have a 10-to-1 leverage, you can have 100-to-1 leverage. Okay, it can vary. Yes, your profits can be maximized, but also your losses. So that's why it's important to really emphasize risk management tools, understand your stop losses, limit orders, always trade with that in place, so you know what your upside is and you know what your potential downside is as well. When it comes to the market hours, look, unlike stocks, Forex operates 24 hours a day, 5 days a week. You got to remember that no matter which way you look, there is some time zone open. So you got Asia that's open from here in UK time from midnight onwards till early morning. And when Asia starts to close, Europe starts to open. And then when Europe's open, halfway through that, you got the US open. Okay, so the best trading time for Forex traders is usually the European hours, because you've got multiple time zones and multiple markets in operation actively trading. So European hours tend to be the best hours to trade. And then finally, you've got long and short positions. Long positions means you're buying the currency pair with the expectation of the base currency increasing in value. If you go short, in essence, you're selling the currency pair with the expectation of the base currency falling, decreasing in value. Okay, so those are longs and shorts we will go into in a little bit more detail as we go along. Okay, now major currency pairs in Forex refers to the most traded pairs out there, and that tends to include the US dollar against other major global currencies. So these pairs are highly liquid, meaning that they are traded in large volumes daily. Okay, that traditionally tends to lead to very tighter spreads. Remember, when we talk about spreads, that's the difference between the buy and the sell price, the bid and the ask price. Tighter the spread means more liquidity, more volume, which is ideal. It allows you to get into the profit that bit easier. Okay, so it makes them a lot more attractive to traders. Each major pair really consists of a US dollar against another major. Okay, so when we talk about Euro USD, it is the most traded pair in the world. It just reflects the strength of the Eurozone economy relative to the US economy. Remember, everything on the left is the base currency. So if we're looking to buy Euro USD, we anticipate Euro to strengthen against the dollar. Okay, and behind that you got sterling dollar, okay, also known as cable. Again, if we do believe the sterling's going to strengthen against dollar, we would go long, or if we feel it's going to be weak, we would go short, or if we feel the dollar is strong, we would short sterling USD. And then you got USD versus Japanese yen, heavily influenced by interest rate differentials between the US and Japan. Okay, when we talk about interest rate differentials, interest rates in Japan are a lot lower, so a lot of people may tend to do a lot of carry trades. Okay, Japanese yen also often acts as a safe haven currency during market turmoil. Then you got dollar and Swiss franc. Again, Swiss franc is seen as another safe haven, so hence the reason why it is considered amongst the majors. Then you got Australian dollar versus US dollar. So this pair is heavily tied to commodity prices, especially metals, since Australia is a major export and Western Australia have big oil and gas reserves as well. And then we've got USD and Canadian dollar. Again, this is closely tied to the price of oil, since Canada is a major exporter. So moves based on both oil price and fluctuations in that region, can move this pair quite dramatically. And then finally, you got the New Zealand dollar against the US dollar. Again, very much commodity based as well. Okay, so these in essence are the major currency pairs that we have out there. So if you are looking to get involved, it's important to study all, but it's always best to master a handful rather than having to trade everything. So that's the way we tend to look at it. And I just also want to track on, why traders focus on, majors. Okay, one is the fact that it is highly liquid. Major currency pairs have, higher trading volumes. They are liquid. So there's a large number of buyers and sellers in the market. So this liquidity ensures that investors can easily enter and exit positions without significantly affecting their price. You don't want to be, clicking the button to buy and the price you get filled at is completely different to what you actually saw on the screen. Okay, if that tends to happen, you're tending to maybe put a huge amount of volume in the market where there's not enough buyers for it, okay, or sellers for it. So you've got to be very careful on that front. Narrow spreads is a key feature for majors. Due to high liquidity, a lot of these pairs typically have very narrow bid and ask prices. So narrow spreads naturally reduce trading costs for investors, making it a lot more cost effective to execute your trades, and you can get in and out a lot quicker. Then you've got price stability. Major currency pairs tend to have relatively stable price movements compared to exotics and minors. Okay, so the stability provides investors with a level of predictability and reduces the risk of sudden price fluctuations. Okay, when I say he's predictable, it doesn't mean that you're not going to see adverse movements, especially when data is being released. But it tends to be a lot more reasonable in pricing movements. That's probably the best way to go about it. And the last one being accessibility. Major currency pairs are accessible to traders around the world. You've got your online platforms, you've got brokerage firms, so you can really access these majors and a lot of the other currencies from exotics and minors, but you really want to be focusing on majors. It's not on here, but risk management is a big part as well. A lot of these majors are commonly used for hedging purposes to manage currency risk associated with a lot of international trade and investment. Okay, so a lot of multinational corporations will hedge their foreign currency exposure by entering into forward agreements or option contracts, and again, all circulating around major pairs. So, yeah, in a nutshell, that is what majors are. My advice would be to focus on a handful, literally the real big ones: Euro USD, Sterling dollar, dollar yen. They tend to be the ones which are, heavily traded, a lot of information out there, rather than focusing on, 7, 8 pairs. You'll be spread quite thin there. Okay, so yeah, those are the majors for you. Okay, now minor currency pairs are also known as cross-currency pairs. These pairs do not include the US dollar. Instead, they involve other major currencies like sterling, euro, as well as yen, and a handful of others. Okay, while they are less liquid than major pairs, miners still have substantial trading volumes going through them. Okay, so it does offer good trading opportunities with higher volatility. Now, I've listed a handful of the examples of a number of miners, so we'll briefly go through them. So you're going to have euro and a dollar. Again, they are two major currencies, okay, but again, they're not going to attract the same amount of volume as you would if the dollar was attached to it, for example. So both these currencies will be influenced by political factors such as leftover remnants of Brexit, disagreements with trade, and so forth. So that what tends to happen along with data and so forth. Then you've got euro and yen. They can be volatile due to changes in risk sentiment, as yen is often seen as a safe haven. Okay, so you could see a lot more fluctuations within that. Then you've got sterling against yen. This one tends to be highly sensitive. You do see a lot of volatility and larger price swings within this pair. So be very cautious if this is an area you're looking to get involved in. Then you've got Australian dollar versus yen. Remember, when it comes to Australian dollar, a lot of the movement will be tied towards commodity prices. Since Australia is heavily linked to exports of raw materials, and you could get a lot of opportunities for carry trades because of the interest rate differentials between the two. I'll mention this as well when we talk about the New Zealand dollar. But remember, you can borrow at a low interest rate in Japan, for example, and then you can invest in a high interest yielding investment in Australia. You're going to have euro, Australian dollar. Again, keep a close eye on raw materials, commodity prices, because that is what will influence the price of Australian dollar. Then you've got sterling against Canadian dollar. Again, when it comes to the commodities, but this is more influenced by Canada is more influenced by oil prices. But really understand the monetary policies of both these regions, and that can decide what currency is worth investing in, or buying or selling, really. And then finally, you've got New Zealand dollar with Japanese yen. Again, with the Australian dollar, popular for carry trades. Okay, so keep a very close eye out on any investment opportunities in that region. And finally, or not necessarily finally, but the next section would be some characteristics of miners. Okay, one is obviously the obvious one. There's no USD involvement, so they don't include dollars. So their movements are purely driven by the strength in each region. Okay, without having the dollar, you naturally will experience slightly less liquidity. Okay, which can lead to higher volatility. Okay, so you will see more exaggerated swings, especially in the likes of sterling yen or euros yen. They do tend to have massive price swings. Anything that doesn't involve dollar naturally is going to be a little bit more sensitive to data releases or information that's coming out. Wider spreads, since minor pairs are less liquid than major pairs, they typically have wider bid and ask spreads. Okay, so this naturally can increase trading costs. There may be overnight interest, which will be a lot more for miners and the likes of the exotics. But the reason why the spreads naturally widen is whichever provider you're with, they take that extra security by widening the spreads. Okay, naturally, if something is a lot safer, a lot more liquid, a lot of the market makers tend to keep their spreads a lot tighter and a lot more competitive with everyone else that's providing these trades. But anything that becomes too illiquid starts to widen out. And finally, one of the factors of miners is regional factors. So unlike a lot of majors where global economic trends and US monetary policy play a huge role, miners are often more influenced by regional economic data, political events, trade relations between those countries as well. So that's one thing to keep a very close eye out on. And yeah, that will help you form the best idea. Finally, I do want to touch upon the unique opportunities and challenges that come with miners. So just briefly going through some of the pros and the cons. Some of the positives with investing in miners is diversification. Okay, investors, miners provide investors with additional opportunities to diversify their portfolio. Okay, when you diversify, remember you help spread risk. Okay, spreading risk across multiple different currencies and economies is important. Okay, but when you do diversify in a slightly more low liquid, higher volatility region, remember there will be cons attached to that. But all in all, it's great to diversify portfolios and spread risk. Okay, one way would be to gain global exposure. Okay, gaining exposure into regions and economies that you've never invested for can provide you with insights into economic developments, geopolitical events, as well as monetary policy decisions in those regions. So you get to diversify and have exposure around the world. One could be based on the fact that you can opt for a more specialized trading strategy. Miners naturally exhibit different price behaviors and different trading patterns compared to majors. So this, diversity offers opportunities for specialized trading strategies tailored towards this, the characteristics of specific miner pairs and, the economies within those regions. Volatility is, I would see as a pro to a certain degree. Okay, because with significant price movements and volatility, there will be that opportunity to gain significantly more profits. Okay, especially if you're trading on the ultra short-term basis, having that volatility can very much work in your favor. Some of the negatives attached with miners will be the fact that there's lower liquidity. Okay, lower trading volumes compared to majors will lead to wider spreads. Okay, and so it will become a lot more challenging to get into profit. Higher volatility and risk can work in your favor, but as we know, it can also work against you. They will experience a lot sharper and less predictable price movement, so be fully aware of that. There is limited market depth. When I talk about market depth, this is a lack of volume. Okay, if you do not have enough buyers and sellers, you are more susceptible to slippage or gapping in any positions that you are currently in. There's always the risk of currency risk. If there's excessive fluctuations in exchange rates, can impact their value, and you really need to carefully consider which currencies you're getting involved in. So those are just briefly some of the pros and the cons attached with miners. But again, a lot of what we're discussing here will also transcend into exotics, but we'll touch upon that next. Okay, now exotic currency pairs consist of a major currency paired with the currency of an emerging or smaller economy. So whenever you look at it, on the left-hand side, the base currency will always be a major currency, and on the right-hand side, the quote currency will always be an emerging or smaller economy. Okay, so these pairs are less commonly traded than majors or minors, so they typically involve higher volatility, wider spreads, and in turn lower liquidity. Okay, a lot of the exotics will be influenced by political, economic, as well as social conditions within the emerging market country. So it can make it that bit more unpredictable. Okay, so I've got just a handful of exotic pairs. There are more out there, so we'll just go into them one by one and just understand what could potentially move them. So when we look at dollar against Turkish lira, this will this movement is really based on the sensitivity to interest rate decisions by the Turkish central bank, as well as inflation rates. You know, how well is their economy, going overall? Okay, then you've got euro against Turkish lira. So again, very much the same thing. Um, Interest rate and inflation decisions in Turkey will play a significant role, along with any other political developments. But yeah, never look back and think it's just down to the emerging market or the smaller economy that will move these. It will still come down to how well the dollar or the euro are faring as well in their own region based on data and so forth. So yeah, always look at both ends of the spectrum. Then you'll have dollar against South African rand. A lot of this will be influenced by commodity prices such as gold and precious metals, since South Africa are a major exporter of commodities. Um, yeah, and that's one way of going about it. The next one would be US dollar and Mexican peso. A lot of this is tied to trade relations between the US and Mexico. US interest rates, Mexican inflation, any political developments in Mexico, as well as their overall relationship, will impact this currency pair. Then you will have Euro and Hungarian forint. It is influenced by ECB decisions and policies, as well as local Hungarian economic conditions. Those are the factors to keep an eye out on. And finally, you're going to have the dollar against the Thai baht. This will be very much dependent on Thailand's tourism department. How well is their economy doing in that area? How well is political stability? And foreign direct investment trends are going to be the key components in determining whether you want to be going long or short. So in a nutshell, those are the major exotics you may want to look out for. But the key characteristics you cannot ignore is the fact that they have lower liquidity. They are traded less frequently than major than minors. So it does lead to lower liquidity. It makes it harder for you to enter and exit trades at the price you would want, and especially in large volumes. Okay, you will naturally have wider spreads due to lower liquidity. Um, you know, the spread will be wider, making exotics harder to get into profit on. Okay, it's very difficult to make an intraday move on these trades. You would may have to hold them for a longer period of time, focus on the long game with that. When it comes to volatility, look, emerging market currencies can be very sensitive to their own political instability, their own data, and the global risk that it could face if things do not work. So this makes exotics a lot more volatile, and you will get a lot larger price swings and a lot more unpredictability. So when it comes to the final part of exotics being risky, I think that's part and parcel with everything we discussed. They do carry more risk due to the economic as well as political uncertainty within their regions. When I say their regions, I'm more talking about the emerging markets, smaller economies, okay, because they are more affected with higher inflation, government policies, as well as geopolitical events. So, those tend to be the core characteristics. But if we were to put it in a nutshell, let's look at some of the pros and the cons of exotics. Some of the pros are potentially higher returns. Okay, there is a lot more volatility. So more volatility can present opportunity for traders to capture larger price movements and potentially higher returns. Just like with miners, you can diversify. Benefit from investing in other regions around the world and other currencies, and it can potentially reduce the overall risk of your portfolio. I use the word potentially because remember, if you are investing in a high risk area, it doesn't necessarily diversify to the effect you may want. There will be interest rate differentials. Remember, some exotic currency pairs involve currencies and countries with higher interest rates compared to other majors, so you can engage in carry trades. There are geopolitical opportunities. Currency pairs are more often, more sensitive to geopolitical events. So traders who can anticipate this and respond to such events can potentially, do very well. Okay, and a lot of that will be looking at data and so forth. And when it comes to the cons, naturally lower liquidity. Trading volumes are very low. You're going to have wider bid and offer spreads, so transaction costs are a lot more, so it makes it more challenging to execute trades at the desired price you would want. With it being higher volatility, yes, there is the opportunity of maximizing and making great profit, but on the flip side of that, there is the chance of significant losses, sharper and less predictable losses, which makes it harder to swallow at times. The key for me would be there's less information and analysis out there, just like with minors and definitely majors. There's so much media coverage and analyst attention. Okay, but here there's fewer resources, less information available, so you're less likely to make the most informed decision possible. So it's always harder to decide whether to go long or short. So yeah, for me, those are the major cons. When the final part could be market depth. Due to the fact that there's less liquidity, there's less volume, you're more susceptible to slippage and difficulty in executing large trades. Okay, without significantly impacting the overall price. So those are the pros and cons. Really weigh it up. Exotics should never form the part of your core portfolio. It can be an area, just like with miners, to diversify, potentially see greater opportunities and greater rewards if you can study the data, understand the regions that bit better, and get as much information, because the only thing holding you back will be the information factor. Okay, you can't just look at charting. You've got to be finding as much information on these regions, what's doing well, what's not doing so well, and how does each currency fare up against each other. So yeah, those are exotic pairs. Okay, now interest rates are one of the most critical factors influencing currency values in the foreign exchange market. And it's not just foreign exchange, it's also affecting strategies like carry trade. It shapes market expectation and it influences inflation and real interest rates. So we'll break it down on how interest rates have an effect on all these areas. First and foremost, on currency value. When a country or when a country's central bank raises or lowers interest rates, it directly affects the overall attractiveness of the currency to foreign investors. Okay, so if we talk about a central bank raising interest rates, it will tend to attract foreign capital, as investors will look to seek higher returns on that investment. Okay, the increased demand will lead to a strengthened currency. Okay, so remember, when we talk about raising interest rates, if the central bank here in the UK raised interest rates from 5% to 7%, for example, and globally interest rates are probably only at 3%. Investors would take the money out of those countries and they would invest in the UK in an investment that would yield a 7% return. Okay, they would seek to benefit from a high interest rate that will strengthen our currency. But on the flip side of that, if you are to lower interest rates, it will discourage foreign investments. They would feel like if we were to park our money here, we're not going to get that much return. Is it really worth it? So it really leads to a decreased demand for the currency, which overall will weaken it. Okay, so that's how interest rates will affect the currency in that area. Now, a carry trade is a strategy where investors borrow money in one currency with low interest rates and invest in a currency with a higher interest rate. The goal is to benefit from the difference between the two interest rates, and this is known as the interest rate differential. Okay, so if, for example, we borrow money and we're only being charged 2% a year on that, great. We can invest that money into another economy or in another country, and they are providing us with an investment of 10%. Okay, so we would take our money, borrow at 2%, and invest it, and every year we get 10%, 8% return overall. Okay, so that's in essence what a carry trade is. I do have an example which I've written down. So you can look at it as, let's say you borrow funds in Japanese yen, for example, and they are charging you 0.1% interest. Okay, so you borrowed money at a 0.1 interest rate. Then you take that money and you invest it in a investment which is in Australian dollar, for example, and it's giving you a 4% interest. The difference between the two rates is 3.9%. Okay, and so that in essence is a carry trade. It happens quite often, but again, you're going to have to be dealing with very large volumes when it comes to it. Market expectation. Now, interest rate decisions are not just about current levels, but also about future rates. So traders will closely follow central bank communication, whether that's just black and white data, or it will be individual speaking. Okay, so they could have a hawkish expectation. If investors expect central banks to raise interest rates due to strong economic data or rising inflation, they may start buying the currency in the anticipation that there will be a higher yield, making it appreciate in value. Okay. On the flip side of that, they could have very dovish expectations where they expect the rate to be lower or they expect a rate cut. It could be down to weak economic growth. It could be down to low inflation. Okay, so the currency may depreciate as traders move capital to other currencies with better prospects. Okay, so that's very important to keep a close eye on. And when we talk about forward guidance, you know, in the US, for example, the Federal Reserve, over here, the Bank of England, you know, they will set out their expectations where they see rates going or where they see inflation heading, and that will then allow you to adjust your stance. I know a lot of the time if you're trading currencies, you're normally in and out very quickly. You're not focused on the long-term scope. But if you are, those are things to keep a close eye on. And finally, inflation and real rates. Now, interest rates and inflation are naturally closely linked. Central banks, as you know, will raise interest rates to control inflation and lower them in order to stimulate the overall economy. Okay, so when we talk about high inflation, we know it erodes our purchasing power of the currency, it weakens it. Okay, and so central banks may respond by raising interest rates to not only contain inflation but also strengthen the currency. Okay, and when it comes to low inflation, it suggests that the economy is perhaps you know, not overheating, and central banks may keep interest rates low or even cut them. Okay, weakening the currency as investors seek higher returns elsewhere. All right, so those are ways in which inflation naturally is affected by interest rates as a whole, and how currency will also be affected. Now, when we talk about real interest rates, this is the nominal rate minus inflation. So for example, if the nominal interest rate is 5%, but inflation is 6%, this is a negative real interest rate. It's -1. This makes investing in the country unattractive, leading to a weaker currency. But for example, if nominal rates were at 2% and inflation's at 0.5%, you've got a positive real interest rate of 1.5%, which could strengthen its currency, and investors would seek to protect, their overall purchasing power. Okay, so if we were to summarize it, remember high interest rates mean a stronger currency attracts foreign investments. Lower interest rates, weaker currency, and it discourages investments. A carry trade, as you know, will boost demand for higher yielding currency, but is vulnerable to sudden reversals. And what I mean by that is, if we take our yen example, yes, you're borrowing at 0.1, okay, and you got a carry trade of 3.9%. But if, for example, you're investing abroad and that country starts to see a lot more volatility, that carry trade can reduce, where it may come to a stage where it might not be a profitable strategy. So you've got to be very careful on how you monitor that. But if everyone was to do that carry trade, the Australian dollar will strengthen a hell of a lot. Okay, when we talk about market expectations, currency movements are influenced by anticipated rate change, not just the ones that have happened. So a central bank can come out and say, yeah, interest rates are going to stay at 5%, but that's fine. We want to know, what are you going to do next month, the month after? Okay, and then finally, it'll be inflation and real interest rates. So positive real rates support the currency. Okay, negative real rates weaken it. Positive real rates are, for example, if the nominal rate is 2% and the inflation is 0.1, then you've got 1.5 positive real rates. Negative will be nominal rates are at 5%, inflation is at 6, you're at -1%. Bad for currency. So understanding the relationship really allows traders and investors to understand and anticipate currency movements based on central bank decisions, inflation trends, and yeah, as a whole, that's pretty much how interest rates affect currency. Again, if you want to dive deep into a lot of these topics, you're more than welcome to. But I feel we've hit every nail on the head. Just just understand how currency will appreciate and depreciate to all these factors. Okay, now we're going to focus on the significance of the US dollar. Okay, historically, it is seen as a safe haven currency, meaning that investors tend to flock to it during times of uncertainty or market turmoil, as well as central banks. Central banks hold a huge amount of reserves of dollar. Now, in order for the dollar to remain a strong safe haven currency, it's going to depend on a number of various factors, which we will go into. Now, when we talk about the historical status of the dollar, the reason it's seen as a safe haven is based really on the size and stability of the US economy, as well as the depth and the liquidity of the financial markets. So naturally, that's what gives it its title as a reserve currency. During times of uncertainty, global crisis, or a global recession, investors often seek safety within the US dollar, as well as US assets such as the Treasury securities. It could be T-bills, it could be T-bonds, or T-notes. Okay, that's just government debt. Like here in the UK, we've got gilts as well as T-bills. Now, with the dollar, there are a number of reasons why it has this significance. One is, obviously, we touched on the reserve currency. Many central banks around the world hold dollar as part of their foreign exchange reserve. Okay, that what gives the dollar a unique position in international trade and finance. So here in the UK, we will naturally have reserves of euro, but we will then have a huge amount of reserves of dollar. Okay, just like Germany and France will, and so forth. Now, when it comes to global trade, dollar is widely used as the primary currency for international trade. So when you think about it, most commodities such as oil and gold are priced in dollar. Okay, so this means that countries need to hold dollar to conduct those trades. Okay, so that solidifies its importance in the global world, but the global international trading community, let's put it that way. Financial markets now, when it comes to the dollar, it is the dominant currency in financial markets as a whole. It's the most traded currency in the world. As many of the financial assets, including bonds, stocks, derivatives, are priced in dollar. Okay, so it makes it a very crucial currency. Even if you look here in the UK, majority of the companies based in the FTSE 100 are based in the US. They do majority of the trade in dollar. So if dollar is increasing, you tend to see the FTSE 100 go up. If the dollar is weak, you tend to see the FTSE 100 go down. Okay, we touched on the fact that it's a safe haven asset, so times of uncertainty or instability, investors will seek safety in US denominated assets, such as bonds. Okay, and this will naturally enhance its overall strength. Looking as well at monetary policy side, so when we look at the Federal Reserve, it plays a significant role in shaping not only US economy but global economic conditions through its own personal decision. So changes in interest rates in the US and any other monetary policy decisions such as QE can have widespread effects on financial markets around the world. Many have probably heard the phrase, if the US catch a cold, we all sneeze. Okay, so it's an important factor, especially if you are actively investing or trading. Is something you would have experienced. So yeah, that in a nutshell is the significance of the US dollar. But those trends can potentially change in the near term. So you want to look at how global trade is going, and with a lot of the wars that are conducted or that are going on, such as Russia, in order to buy oil off Russia, you would normally have had to do it in dollar. Now you have to do it in rubles. Okay, India are very much going down the same route, and that a lot of that is to strengthen their own domestic currency, becoming less reliant on the dollar. Okay, otherwise the US can pull all the strings. Another way you could look at it is you've got to look at the BRIC nations: Brazil, Russia, India, China, South Africa. They're getting members. A lot of the UAE countries are becoming members as well. And you got to think, with all these nations, they tend to control majority of the oil, majority of the gas globally. Okay, so they in essence could create their own central bank if they wanted to, their own currency in the future, which then may become the new safe haven investment. So all these factors you want to consider, as many other regions around the world are in a position where they want to have less reliance on dollar. Okay, so there could be a power shift in the coming years. Okay, here we've got a couple of very quick examples of how a Forex trade works very much in the real world. So we'll look at two examples, one of going long and one of going short. So just to emphasize once again, when we talk about going long, we believe that the currency, particularly the euro, will appreciate in value against the dollar. And when we talk about going short, we believe the euro will weaken against the dollar. Now let's have a look at the first example here. Now, if you're looking to buy Euro USD, you believe that the euro will strengthen against the dollar, and so then you might decide to go long. Okay, so this example, a trader buys one standard lot. Okay, a lot is the equivalent of 100,000 units, or in monetary terms, it's usually around £10 a point. Okay, or £10 a pip in this case. Okay, and let's say you go long and the current rate for the pair is 1.1200. Remember, when we talk about a pip, it is the fourth decimal point that we will be keeping an eye on. Okay, so you're essentially buying 100,000 euros and selling the equivalent amount of US dollars. Okay, but without going into a huge amount of detail, just remember, when we talk about one lot, that is usually £10 a point. You can do spread betting where you don't have to worry about lot sizes. You can just put the pounds in the column of how many pounds a point you want to, in essence, bet. Okay, if you are working on lot sizes can be a lot smaller. You can go from £1 a point, it can be 50p a point, depending on what platform you're naturally with. Now, when we decide to go long, what would be the reasons for buying Euro USD? Okay, why do you believe the euro will strengthen? One could be based on positive eurozone economic data. Okay, so strong GDP growth or lower unemployment in the eurozone could lead to euro strengthening. It could be the ECB tightening, so they're expected to raise interest rates, which appreciates the currency, making the euro that bit more attractive. It could be everything down to the dollar. We could have a very weak dollar. There could be signals of a rate cut or weak US economic data, such as weak non-farm, so didn't reach expectations of the number of individuals employed for the previous month. It could be just geopolitical stability in Europe as a whole. Improved political stability or reduced uncertainty in the Eurozone can help boost the euro. So those are the reasons why you would want to go long, okay, because you believe the euro will strengthen against the dollar. Now, on the flip side of that, you will have the option of maybe going short, okay, where you believe the euro will actually be weaker against the US dollar. Okay, so you might decide to go short. All right, and we'll use very much the same example. If a trader sells one standard lot, okay, which is 10,000, 100,000 units, they believe obviously dollar will strengthen. And remember, it's around £10 a point. It can vary platform on platform, but it is roughly around £10 a point. Now let's look at reasons why the euro could weaken. And it'll be just the complete opposite of what we've discussed. It could be weak economic data, it could be low inflation, it could be high unemployment, just a whole weakening within the Eurozone by way of data. There could be very dovish policies where the ECB expects to lower interest rates. Remember, if interest rates are lower, less appetite for that currency. It could engage in quantitative easing, which means flooding the market with more money. It will just make the euro that bit more unattractive. Okay, it could be down to a strong dollar. The Fed could increase interest rates over there, which makes it that bit more desirable. We could have very strong US data. Could be high GDP growth. It could be high levels of employment, which will make the dollar that bit more attractive. And then finally, you can have a political instability in Europe. It could be elections going on. Okay, there could be trade disputes. All of that uncertainty will weaken the euro. So these are the typical examples that you will naturally look out for, whether you're deciding to go long or short. Everything, it will be very much data driven. Now let's have a look at the P&L calculation. Let's say, for example, we went long and the euro did strengthen, okay, in our favor. So if we were to buy at 1.1200 and it went to 1.1300, we've made 100 pip profit, okay. I'm not taking into account overnight holding fees or any other fees attached to it. Let's just use it on its raw example. So that's 100 pip movement. 10 times 100, so £10 times 100 is the equivalent of a £1,000 profit. Okay, simple as that. You could have held this position for, well, a 100 pip swing intraday is quite a lot. You don't always get that sort of swing, but it can happen. Could be over the course of a couple of days. All right. On the flip side, if we went short and the Euro USD went down to 1.1100, that would be 100 pip profit on the downside. Again, you would make £1,000. Remember, we're not taking into account any fees, overnight charges, or any of that. But these are the quick examples that I just wanted to show you on how individuals go about trading and what the signs are that they look for. All right, so as much as the example is important for you to understand, I just want you to go back and really understand the key reasons why you would decide to go long of something or short of something. If you're going long, you believe that the euro will strengthen against the dollar. Understand those reasons. If you're going short, you believe the euro will weaken against the dollar, and really establish those reasons once again. Okay. Currency market analysis involves studying and predicting the behavior of different currencies in the Forex market. Now, there are predominantly two main methods of analyzing the markets. That's not just currency market, but that's any other form of market. And that's usually via fundamental analysis as well as technical analysis. Now, combining both approaches gives traders a well-rounded view of potential market movements. Okay, I know a lot of people will be focused very heavily on the technical side, reading charts and patterns, but it is also essential to really understand data releases, how investors digest that information, as well as understanding fiscal and monetary policies to assess the direction of an overall economy. So we'll first fire into fundamental analysis, and see how that really affects markets as a whole. Now let's focus on interest rates. Now, if you've watched the slides previously, you will be pretty well aware of how interest rates work and how currencies are affected. But for the sake of this slide, and for people that may be watching it the first time, we'll go over a lot of these key elements, not just interest rates, and just recap you once again. Now, when it comes to high interest rates, if interest rates are going up, for example, it tends to attract foreign capital inflows, okay, increasing demand for the currency and leading to appreciation, based on the fact that investors are taking advantage of a high interest rate here means that potentially higher returns on their investments. Now, on the back end of that, low interest rates can actually weaken the currency, as investors will look to take their money out of here and start investing into other areas or other countries where the returns are higher. So it's important that traders closely monitor central bank rate decisions, understand forward guidance, as that will help you anticipate future monetary policy actions that will allow you to then adjust your own trading positions accordingly. Economic indicators. I'm a big fan of understanding and benefiting off data releases, but as a whole, economic indicators will give us an understanding of the health and the performance of a country's overall economy, and that naturally influences currency values. So really breaking down GDP figures, inflation, CPI figures, employment, unemployment data, consumer spending, okay, this will help you assess the strength of an economy and its potential impact on currency values. Okay, so strong economic data tends to lead to currency appreciation. Okay, always remember that whenever you're trading based on the economic calendar, strong data tends to lead to appreciation within that currency, while weak data can result in currency depreciation. Now, when it comes to central bank policies, we're not just here talking about interest rates, but we're also talking about potential quantitative easing programs or forward guidance. Central bank policies have a direct impact on currency values, as they do influence interest rates, and that will naturally change market sentiment. Okay, so it's not just the black and white figures. I also want you to keep a very close eye on speeches by central bank officials, and to really gauge their understanding of future monetary policy decisions, because you can adjust your decisions based upon that. Individuals that come out and suggest what the likelihood is of interest rates going up or down in the coming months is important. Forward guidance helps us really understand which way inflation will be going, which we'll touch upon in a second. Now, trade balance. A trade balance reflects the difference between a country's exports and imports. A trade surplus results in exports exceeding imports. Okay, more of a country's goods are going out to the wider world than they're having to import in. This will lead to currency appreciation, as it does reflect strong demand for the country's goods and services, which is great. On the back end of that, a trade deficit. This is where a country is importing more than it is actually exporting. This will lead to currency depreciation. Okay, so for traders, just analyze the data and assess the country's trade dynamics and the potential impact it will have on currencies. Inflation rates. Now, high inflation, as we know, erodes purchasing power, and this will lead to currency depreciation. On the backside of that, or the back end of that, if inflation is low and stable, okay, is generally seen as a positive sign for currencies. Okay, so always keep an eye on CPI data, see where the guidance figure here is, preferably around the 2% mark, which as of this video we are. So that's where you would want it to be. And finally, government debt. It's not, understanding interest rates and monetary policies is important, but also understand the other side of that. Understand the fiscal stance, okay? As government debt levels will have an impact on currency values, it will influence investors' confidence and perceptions of the overall sovereign risk. High levels of debt relative to GDP will lead to concerns about fiscal sustainability, and it could lead to currency depreciation. Ask yourself, are you more likely to invest in a country or in their currency based on the fact that economically they are not in a sound place? Okay, so debt levels and fiscal policies will help gauge a country's overall credit worthiness and the potential impact on currency values. So in a nutshell, that is the fundamental factors we would want to look at and really take a important note of. Now we will touch upon the areas of the technical analysis side. Okay, it is an essential aspect of Forex trading. It does focus on analyzing historical price data, market patterns, all to forecast future price movements. Okay, so when we talk about chart patterns and trends, okay, chart patterns could be head and shoulder patterns, they could be triangles, they could be channels, it could be a certain range. This is to identify where the trend is and where there is a potential reversal of that trend or a continuation of that trend. Okay, so this slide is not going to be teaching you how to trade, but these are just small fundamental factors. We do have a seminar focused on just purely the technicals of it all. But then you will also have trade analysis. Okay, overall, traders will determine the direction of a market, by looking at range of trends, whether it's a bullish trend where the market's going up, or whether it's a bearish trend where the market's going down. Or it could be like where we're right now in the UK with the FTSE 100 trading very much within a range, got a very defined, a very set resistance level and a very set support level, and it tends to trade quite actively within that range. So chart patterns and trends are important to take note of. The next one would be understanding support and resistance levels. They are technical concepts used to identify price levels where buying or selling pressure is likely to emerge. So if we talk about support levels, these are levels where buying interest is expected to outweigh selling pressure. So it could be a case of looking at a Bollinger Band, for example. If you see chart patterns approaching the bottom band, you would look to go long. Okay, so anything near support, you traditionally tend to go long, you buy. If something is at resistance level, this is a price where selling interest is expected to outweigh buying pressure. Okay, so it's a level where they don't believe the price will go further. So if you're near resistance, you traditionally tend to go short or you tend to sell. Next, you've got moving averages. Moving averages really are a trend following indicator that smooths out price data by calculating the average price over a specified period of time. You can have a 20-day moving average, 50-day, 100-day, or you can make it a lot more bespoke. So the common types tend to be SMA, which is a simple moving average, or you've got an EMA, which is an exponential moving average. EMAs take into account more recent data, tend to be less reliable in certain circumstances, but you naturally tend to use them hand in hand. So you would ideally look for moving average crossovers in the short term that can help you understand if a trend has changed or not. Okay, then you've got RSI or stochastics, which fall very much into the oscillator range. Okay, I tend to use them quite a lot. They tend to work very well. They are momentum indicators to measure the speed and the magnitude of price movements. So oscillators in general help identify overbought or oversold conditions in the market. Okay, overbought is when it's reached a level where they believe buying pressure will slow, if not stop, and in turn selling pressure will come into account. So if something is overbought, you tend to go short, you tend to sell. If something is oversold, okay, it tends to mean that selling pressure is going to slow and buying pressure is more than likely to take place. So if you're at support, you look to buy. Oversold, you buy. Okay. And then finally, we look into market liquidity and trading volumes. Okay, looking at liquidity and trading volumes are essential factors in technical analysis, as they can influence the reliability of patterns as well as signals. So high liquidity and high trading volume is generally sought after. You tend to get a lot of that during the European Open. That's when the most active trading does take place. If you've got low liquidity, low trading volume, you are more susceptible to um, bigger gaps, not getting the right fills, and um, not gauging the market right. So whenever investors and traders are always trading, it's usually during periods of high liquidity and a lot of volume going through the market. So that, in a nutshell, is currency market analysis. These are the main factors that you want to focus on. Understand the fundamental factors. How does that affect currency? And then if you are looking on the short-term basis, really look at the technical factors and how you can gauge the best trade moving forward. Okay, now we're going to just summarize everything we've discussed and focus on the core strengths and weaknesses, or what really strengthens and weakens currencies. As I feel this one slide will bring together everything and should be an ideal finishing point. So let's focus on factors that strengthen a currency. High interest rates. Okay, we know central banks, when they raise interest rates, it becomes more attractive for foreign investors to hold assets in that currency, purely based on the fact that they will earn a higher return. So the increased demand for the currency will strengthen it. Okay, an example will be if here in the UK we raise interest rates, sterling will typically appreciate, as global investors will look to buy sterling to benefit from the higher returns in UK investments. The next one will be strong economic data, factors such as GDP, unemployment, low unemployment, high employment, manufacturing. A lot of that will attract foreign investments due to the fact that the economy is improving. So any inflow of capital increases demand for the local currency. The next one will be reduced money supply. If the central bank tightens monetary policy, the money will naturally decrease over time. So the fewer currency units available, each value will increase. It's just a supply and demand factor. Demand remains high, supply remains low, prices tend to go up, and vice versa. Low inflation. Low inflation preserves the purchasing power of the currency. Okay, so when inflation is under control, the currency remains and sustains its value. So it attracts investors who are confident in its overall stability for the medium to long term. Political stability. This is a big one. Any form of government stability increases confidence in the overall economy, as well as the governance of that country, making it a lot more of an attractive destination for foreign investors. So investors are less likely to fear any form of sudden changes in fiscal or economic mismanagement. You will naturally notice that a lot of countries with a lot of turmoil going on, or power struggles, their economies tend to be very much on their knees and less appetite for their currency. The next one would be a trade surplus. A trade surplus always occurs when a country's exports more than it imports, meaning that more foreign buyers need the country's currency to purchase the goods and services. Our goods are in demand. We don't need much from outdoors. Okay, so the higher demand strengthens the currency overall. Overall positivity, a positive market sentiment towards the economy, policies, future prospects will naturally lead to an increased investment and demand for its currency, driving its value that bit higher. So those, in a nutshell, are the main strengths we want to, the main strengths or the main factors that strengthen the currency. Finally got it out. Okay, the next one will be factors that weaken the currency. A lot of it will be the complete opposite of what we've just discussed. Okay, so start off with lower interest rates. It makes the country's assets less attractive to foreign investors because they offer lower returns. Okay, so the reduced demand for the currency leads to depreciation. Weak economic data, so we could have high levels of unemployment, low levels of employment, very low GDP, very weak manufacturing output suggests that the economy is underperforming. This can discourage a lot of foreign investment and decrease demand for the overall currency. QE, quantitative easing. QE involves the central bank purchasing large amounts of government securities from financial institutions and so forth. This is designed to inject liquidity into the economy. So if you increase the money supply, this dilutes the currency value, which will naturally weaken it. Okay. Then you've got high inflation. High inflation, as we know, erodes the purchasing power of the currency, making it less attractive to investors. So a currency losing value domestically is often perceived as being very risky, leading to a lot of sell-offs and depreciation in the currency. Now, having a trade deficit, that occurs when a country imports more than it exports. Okay, more of the country's currency flows out in order to purchase goods, reducing demand for the own domestic currency, in turn weakening it. Okay, and then we've got government debt and fiscal deficits. Now, high levels of government debt and large fiscal deficits can lead to major concerns about the country's ability to manage its finances, not only for the near term but for the long term. So investors may fear future tax hikes, inflation may go up, or even default. Okay, very rare that is. Okay, but that naturally lowers confidence in the currency, less demand for the currency, and in turn it depreciates. And finally, there will be negative sentiment and market fear. If there's any of that going around, there could be wars going around, there could be geopolitical unrest, there could be referendums. So any fear and uncertainty surrounding a country's economic or political future can lead to capital outflows. When we say capital outflows, money going from the UK out. Okay, people may be selling their assets here and putting them abroad. So they will just move their money to safer assets, but not in this country or in this currency. So this will drive down demand for the local currency and naturally weakening it. So these tend to be, the key factors that strengthen and weaken currency. So please take note of them. Go over this slide again if you need even further reassurance. But these factors you should be looking at, especially if you're speaking to investors and they may have an interest in the Forex markets. At least you can go through it and guide investors on where you will see appreciation or depreciation in currencies. And again, you'll be more of a useful asset when trying to bring on board investors or cross-sell to your clients.